Tons of Fed speak and a little bit of economic data. What more do you want? Live from New York City this morning. Good morning, good morning. Just a little bit softer on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, views beginning to splinter at the Federal Reserve, some cracks beginning to show at retailers, and Yellen doubling down on an early June ex-date. We begin with the big issue, challenging the resilience of the U.S. consumer.
Consumers are proving resilient.
The consumer looks strong.
Still strong.
Consumers are still spending.
They are able to tap into some stored wealth.
Consumers okay, but it's the consumer's behavior that we're worried about.
You've got growth problems that are starting to emerge.
A lot of cracks surfacing.
Signs of worry.
The rise in credit card rates and the rise in revolving lines of credit.
The consumer is on fragile footing.
They are waiting for the other shoe to drop.
In the second half of this year is when things start to unfold.
Maybe later this year rather than earlier.
We will be watching the earnings closely.
This week could be very important.
I'm pleased to say that joining us now to discuss is Mohammed Al-Aaron of Queen's College, Cambridge. Mohammed, good morning to you.
Good morning. Thanks for having me, John.
We have found the pain point for regional banks. Have we found the pain point for rates for this economy?
Not yet. There is so much confusion out there that people are not even sure where the rate point is. What we do know is that the consumer is holding on better than most people expect, and the global economy around us is weakening. That's what we know. What we don't know is what is the right level for interest rates. And I would go one step further. What is the right inflation rate for this economy?
We're going to pick up on that point a little bit later on this morning, because I know you've got a lot of thoughts on that. The Fed speak of the week so far, there's tons of it. Concludes with Chairman Powell later on this week on Friday. Goolsbee suggests maybe we're done here. He was close to being done at the May meeting. Kashkari is talking about perhaps being open to more. Where are you right now?
So it is fascinating to me that to see the range of views. As you say, there's one view we should have not increased last time. There's another view we should increase next time. Then there's the collective view of the Fed, which is we will not cut rates, versus the market view that we will cut rates. John, that tells you three things. One is the economic situation is fluid. Two, compositional issues matter. If you look at the service side, you get a completely different set of answers than on the good side. And three, the Fed hasn't anchored expectations. We have no view of what the strategic and secular view of the Fed is. And until we get that, you're going to get more splintering, not less.
Do you believe that the effort to get inflation back towards target is time sensitive? Or do you think you can push out the time horizon to ultimately achieve that goal?
I think ultimately you will push it out, because achieving it in a short span of time has too much cost for the well-being of Americans and for the well-being of the global economy. You cannot crush the economy to get to 2%, because we are living in a world of deficient aggregate supply. And if you try, it will be counterproductive.
Just to be clear here, this is still your opinion, that to achieve a 2% inflation goal, you would have to hammer the economy. Now, when you say crush the economy, you're talking about unemployment of 5, 6, 7, 8%. What are you talking about here?
I'm also talking about the inability to bounce back quickly. So there's a dynamic here. If you try to run an economy at an inflation rate that is too low, given the amount of resource reallocation that's going on, then you will crush it. Look, we have three issues standing there. We have a major energy transition that we have to navigate. We have the rewiring of the global economy that's happening not just for geopolitical reasons, but also for companies looking for more resilience. And then we have the functioning of the labor market. You put these three things together, if you try to get to 2% quickly, the cost far exceeds the benefits.
Well, you know what the Fed implies right now in its projections, median forecasts right now. Unemployment goes to 4.5%. Rates stay here, implied by the median dot, and inflation is on a glide path back towards 2. How would you characterize those forecasts from the Fed? They get updated in June, by the way, as you know.
I would characterize them the same way I've characterized almost every single forecast we've had for the last few years, as hopeful but not realistic. We haven't talked about the third part of the trilemma, financial stability. right? So there's three elements. And that's what you get when you're late, is your dilemma turns into trilemma. And we have to talk about financial stability as well. So look, unless the Fed comes out and anchors quickly the markets, where in terms of what is its characterization of the medium term, we're going to get more and more differences, not fewer.
We've gone back and forth on the regional banking stress. I've called it a crisis, you've called it something else. We won't debate that here and now, but you've talked about the several phases of it. What phase of that are we in at the moment?
So we are out of the ICU. That was the acute phase. We are still in the hospital because there are problems with the banking model of certain banks. And the key issue now is to allow the patients that are in the hospital to come out. And if there's another policy mistake, the patient goes back into the ICU.
What would a policy mistake look like?
If, for example, we ignore the fact that we can't get to 2% inflation easily and we go after it too quickly, that would put the patient back into the ICU and would bring back a second set of patients that we don't talk about, the non-banks, what's happening in the non-bank financial sector.
What do you think is happening there right now?
So the good news there is it's slow moving. So think of commercial real estate, think of the 1.5 trillion that has to be refunded. That doesn't happen immediately. That's the good news. You don't have the dynamic of deposits. The bad news is that's going to happen over time. So we've got to be really careful to navigate what's coming.
All roads here seem to lead towards this idea, Mohammed, that you think this Fed should be done and should come out and explicitly say it, and that they're done because they think an inflation target of 2% is unachievable. How on earth do you go around communicating that?
That is a problem. This Fed hasn't been known for good communication. It's been known to more confuse markets. We have the study that shows that volatility is 3 times as high during the current press conferences than they were before, that the market ends up feeling one way after it felt the other way after the statement. So communication is an issue, and we need to get that clarified. Having said that, John, it is really important for everybody to know where we're going to. Everybody's data dependent. So it's as if you're driving on a freeway and you just care about the cars around you. There's two other things you need to know. What is my destination and is it feasible? You need to know these two things. It's not enough to be data dependent.
What does that phrase even mean anymore? That phrase drives me nuts.
It does drive you.
What does it mean anymore?
It means that I don't want to take a strategic view. I don't want to put my views out there, so I am going to be completely tactical. However, there's a problem, which is you are tactical with a tool that operates with lags.
The long and variable lags. Governor Jefferson talked about them. How long and how variable are they?
They are not as long as they used to, but they're long enough for you to have a forward view and not just a backward view. And we got to get out of this excessive data dependency. You should be data dependent, but in the context. The great discovery of Bill Gross at PIMCO was that you should always have a secular and structural underpinning to what you're doing today. Don't just get whipsawed by the markets. Have a view as to where you're going. And the Fed needs to share with us what is that view? What is the characterization of the economy we're functioning in?
Which is why you used to have both a cyclical and a secular outlook, and PIMCO, by the way, still does. Are you suggesting that's what the Fed needs to provide now?
Absolutely. I mean, the only secular view we have comes from the new monetary framework, which is a world of deficient demand. But we live in a world of deficient supply. So we have a framework that is built for the world of yesterday and not built for the world of today or tomorrow.
Mike McKee's been looking at some of these things down in Florida, catching up with Fed speakers and, of course, reacting to the latest economic data as well. Mike McKee, let's start with the data first and then shift to the Fed speak. What did you make of that retail sales print from 36 minutes ago?
Well, it does suggest that the consumer is hanging in there. There's a lot of things you want to do with the data, massaging it in terms of the fact that Easter moved from March to April this year, and so it affects the skew of the data. Also, energy prices coming down. But as you can see, the trend is up, and it does show that consumers are hanging in there, which just makes it a bigger question for the Fed about what that's going to mean. It helps them with the idea of a soft landing, but what we don't know is whether or not it's going to be inflationary. Some of the inflationary categories like gasoline dropped in retail sales this month, but there are still wage pressures out there that Fed officials are worried about. We had Loretta Mester this morning speaking over in Dublin, Ireland, saying that she doesn't think that the conditions yet for a pause have been met.
Mike McKee, thank you, sir. Thought Mike might have some sound there. but he doesn't. Mike McKee, thank you very much. I want to turn to Home Depot numbers just quickly. They came out in the last couple of hours and the stock is down by about 2.9% in the pre-market. The company coming out in the last couple of hours, Mohammed, and basically communicating to us that they've had to cut the outlook for 2023. Clearly there was some pull through, some pull forward of demand here for this company. The goods sector, we had a guest earlier on this morning on Bloomberg Surveillance, I'm sure you may have heard it, who said that we face a discretionary recession. And the question I was asking is, does that go from goods to services? You've seen that in goods. Do you see the potential for that to bleed to services?
It may bleed, but we are really far away from this. And that's one of the challenges of the Fed, is if it looks at the goods sector, it is relaxed. If it looks at the service sector, it is worried. And we need to spend a lot more time understanding the dynamic of the service sector. Look, John, you have two sets of companies now. The extremes are Home Depot and the airlines on the other side. Home Depot has inflation biting into declining sales. The airlines have pricing power and have massive demand. And what we're going to see increasingly is this dispersion in companies depending on which sector you are serving.
We'll catch up on the retailers through the week, of course. It's not just Home Depot earlier this morning, it's Target tomorrow, Walmart the day after that. Looking at S&P 500 futures right now, around about 20 minutes out from the opening bell. Equity futures on the S&P, negative 0.3%. Mohammed's going to be sticking with us. Let's get you some movers. Here's Abby.
Let's stick with Home Depot, John, because it really does stand out with the stock down. Cutting the outlook, the quarter that just was weak. Also, demand weak for sales, which missed. They're now talking about sales comps for the year of down as much as 5%. Previously, they had been looking at flat. They're talking about the discretionary spend not there. Some of the other categories, such as plumbing, that are more necessary, that's strong, but patios and grills, not so much. Turning to one space that's up today, Capital One, we have those shares popping sharply higher as Berkshire Hathaway takes a stake. We also have Nubank higher. They put up a strong quarter. That's another Buffett-backed bank. Horizon Pharma, on the other hand, plunging down 18%. We have the FTC challenging Amgen's $28 billion deal. This would be the biotech giant's largest deal in history. They are basically saying it could hamper innovation and slow the pace of drug development. Not surprisingly, Amgen's higher, but not so much. So it's going to be interesting to see how this story evolves with time, John.
Abby, thank you. We'll touch base with you again in about 20 minutes around the opening bell. Coming up, Speaker McCarthy sounding pessimistic ahead of a second round of debt ceiling talks.
We're only a couple weeks away. You've got to have something done by this weekend. We are nowhere near any of that.
That conversation with Mohammed Al-Erin, JP Morgan's Kelsey Barrow and AB's Gershon Distenfeld up next.
The staff is very engaged. I would characterize the engagement as serious, as constructive. The most important thing is making sure that Congress fulfills its basic responsibility to avert default.
National Economic Council Director Lau Brainerd calling staff-level talks both serious and constructive. Here's House Speaker Kevin McCarthy's take on the same thing.
We're only a couple weeks away. But if you look at the timeline to pass something in the House and pass something in the Senate, you've got to have something done by this weekend. We are nowhere near any of that. I appreciate the president signing in to talk after 97 days, but there is no move.
According to him, staff-level meetings are not productive at all, and we are nowhere near reaching a conclusion. Meanwhile, Secretary Yellen is doubling down on her warning in a letter to congressional leadership, writing the following: "We still estimate the Treasury will likely no longer be able to satisfy all of the government's obligations if Congress has not acted to raise or suspend the debt limit by early June, and potentially as early as June 1st. Yellen indicating the U.S. is already paying the price. Joining us now from Capitol Hill is Kayleigh Lights. Hey, Kayleigh.
Hey, John. Well, there seems to be diverging views clearly on how much progress staff-level talks have made in recent days, but it is going to be the principals in the room today at the White House. President Biden, along with Vice President Kamala Harris, will be meeting with House Speaker McCarthy, as well as the other big congressional leaders. So there is a question of whether or not we will emerge from that meeting in the Oval Office today, what we will hear when they all go to the sticks and speak about the progress that they made in the room. What we understand is on the table are ideas like spending caps, though the Biden administration would like that to be in shorter duration than Republicans would like. Permitting reform also on the table, as well as work requirements for entitlements. The thing is, John, that even if these 5 really can reach a deal today. That is just part one. This still needs to be sold to the rest of Congress and ultimately passed. That is where the timetable gets incredibly difficult because remember, the president is scheduled to depart for Japan tomorrow. And of course, the Senate is scheduled to go on recess starting Thursday through the Memorial Day holiday. So the clock is ticking as Treasury Secretary Janet Yellen reminded Congress yesterday. Not only did she reiterate it that it could be as early as June 1st that the Treasury is unable to meet all of its obligations, she also warned about cutting it too close to the X date, really hearkening back to the 2011 episode, saying we have seen that pushing it too far near the brink can raise taxpayer borrowing costs, impact confidence, and of course ultimately affect the credit rating of the United States. And she of course pointed to the market action we have already seen in how the Treasury's borrowing costs on maturities, securities maturing in June have moved higher. It's a warning from Yellen, John. The question is whether the negotiators today will be heeding it.
Here we go again. Kayleigh, thank you. Joining us now to discuss JP Morgan's Kelsey Barra, AB's Gershon Distenfeld, alongside us, Mohammed Al-Arian. Kelsey, first of all to you, and fold in this debt ceiling drama down in Washington as well. You and the team seem to believe that the road to recession is already paved. Why?
Well, we see the cumulative and lagged impacts of 500 basis points of rate hiking, the fastest monetary policy tightening since the 1980s. You add on a quantitative tightening, a highly uncertain situation with the debt ceiling, and we see the leading indicators, whether it be NFIB, Conference Board, they all suggest that growth and inflation should be continuing to slow. Now, I know we're hearing a divergence of Fed views right now, and I'm not surprised that they are not admitting victory at this point. They are going to be very hesitant to admit victory, and here's why. They have 500 basis points of policy space. That's way more than they've had in the last multiple decades. So for now, they're going to maintain a hawkish bias, or at least one where they are on pause. But in the background, we do feel that the leading indicators are already pointing towards slower growth and ultimately a recession.
Gershon, let's build on that. Is it time to put on end-of-cycle trades? And what are end-of-cycle trades in the cycle like this one?
That's a very hard thing to gauge, John. You know, the reality is that, you know, we're all obsessing over, did the Fed make the right move, you know, earlier this month by hiking rates? What are they going to do next time? And the real issue is, how long do they stay here? And, you know, we continue to think what they've said, and this is where I disagree a little bit with what something Mohammed opened with, that there's no strategic plan. I think there is a strategic plan. I think they've been clear that they're willing to wait it out. They don't want to repeat the mistake of the 1970s. So they're going to keep rates high for quite a bit of time. Now, why does it appear like they're not clear? It's because, you know, the market mostly cares about what they're going to do next time. Where is the terminal rate going to be? Which is just not as important. So they don't communicate very well on that. But I think they have communicated pretty well that they're going to be higher for longer. They disagree with where the market is. And yes, that probably leads to a higher chance of recession, and portfolios should be positioned that way.
Gershon, in the old days, you never took on the Fed. If it is true that they have been so clear, why is it that the market is not listening? What is the market seeing that the Fed is not seeing?
Well, I think the market may be saying that there's just a much higher probability of something bad happening. If I look at the last 4 times that the 2-year note traded over 100 basis points below Fed funds, we're thinking about 1989. We know what happened there. 1998, we know what happened there, 2000, and 2007. All times where, you know, for different reasons, the markets were about to fall apart. So I think it's a very, very bearish sign. You know, haven't been a huge believer in just looking at the yield curve, but the fact that it is so inverted is saying that it's likely something bad's going to happen. Now, what is that bad thing? Could it be the debt ceiling debacle? Could it be reignition of bank fears? It could be a severe softening in the labor market. Who knows? But I think that's what the market is pricing in. Maybe consciously, maybe not consciously.
So, Kelsey, you said earlier that you feel that there's something bad will be the high likelihood of a recession. Can you speak to the nature of that recession and whether it triggers the credit risk concerns that then undermine the marketplace and undermine the recovery from that recession?
So What I heard from your question on credit risk specifically, the default rate has been very low so far in this cycle, but we are expecting that it's going to start rising. And so, yes, in a recession, you are going to have a higher defaults. You're going to have a higher default rate, and spreads are going to need to widen to compensate for that risk. So, as we adjust portfolios, the way that we're positioned is long duration, but also up in quality. So investment grade over high yield, looking at things like agency mortgage-backed securities, where spreads are 150 basis points over the Treasury, and that's for something that's government guaranteed. So, exactly how deep the recession, we're not sure, but when we look at where spreads are currently priced, they're not really priced for any type of recession, whether it be a garden variety recession or a more severe one.
Gershon, let's speak to that and build on it a little bit more. Can you tell me how you're thinking about the performance of credit, high yield versus, say, equity right now, and within high yield, loans versus, say, bonds?
Sure. I mean, to start with, I think I differ a little bit with Kelsey in that, spreads are incorporating quite a bit of stress. You can't go apples for apples. You look at spreads, they look kind of average, median, but the quality of the market is so much better. We went through a cleansing period over the past 3 years where you did have a lot of defaults 2 and 3 years ago. So I think the starting point is much better. So I wouldn't go crazy. I certainly have an upper in quality bias, but I don't think that we could say that spreads definitively are not compensating you. As you're alluding to, John, I continue to think that the equity market is telling a very, very different story. And in fact, if you believe the equity market is saying that things are going to be pretty sanguine here, I think high yield's pretty cheap. Now, it might go the other way as well. High yield versus loans, I don't really have a strong opinion at this point. I would just point out, and this applies both in the public and private markets, when you're looking at floating rate debt, that's obviously performed very well for investors in this rising rate environment of the past 18 months. But now those companies have increased interest obligations. And one has to look at that very, very carefully. Companies had a choice years ago. A solid double B could have issued at 4.5%, 5% 2 or 3 years ago. And if they did, they have that rate for the next 5, 6, 7 years.
Yeah.
If instead they chose to take, at the time, the cheaper path, issued it in the loan market at LIBOR plus 325, they had a lower cost of financing for a while, but now their cost is 8% and maybe even going higher. So one has to be very careful looking at an entire capital structure, how much exposure there is, and whether a company really can repay their debts.
Hey, Gershon, great to catch up alongside Kelsey Barra. Mohammed, I'm pleased to say, is going to stick with us. Up next, the morning calls, and later, Tony Dwyer of Canaccord Genuity. Seconds away from the opening bell in New York. Good morning to you. Equity futures going into that open just a little softer, negative by 0.24% on the S&P 500. On the Nasdaq, we're negative here by about 0.25% also. Weaker after retail sales of the control group still look pretty resilient and strong. Home Depot, though, flagging some cracks for the US consumer. There's the opening bell. Switch to the board and get to the bond market. Yields look a little something like this on a 10-year, higher by 4 basis points following that retail sales print, 354.52. Look out Europe. Really interesting story emerging here for the euro. The data's starting to weaken. 108.76. Last week was the worst week for the euro, going back to September 2022. The data this morning, the ZEW, investor confidence in Germany, not that important, but starting to crack just a bit. Worth taking a little bit more attention and placing it on what's happening in Europe at the moment. Crude right now, $71 and about 13 cents. We're virtually unchanged there on crude in the commodity market. Let's get you one stock to watch at the open. Home Depot, been talking about it all morning. The retailer cutting its outlook for the year after first quarter sales dropped more than expected. Abby has more. Hey, Abby.
Hey, John. Well, I would categorize this one as worse than expected because the expectations going into this quarter were not great. Analysts, investor strategists talking about the idea that slowing consumer demand could weigh. That did, in fact, happen. Sales missed in a big way. They missed by about down, a miss by about 3%, down by about 4%. There were earnings of $3.82. That was a drop of 7%. The last time we've seen a decline in the numbers, the financials for Home Depot, goes back to February of 2020, right as the pandemic was starting. So they're talking about lumber and weather, but when we break down what was doing well and not well, millwork, building materials, hardware and plumbing, that was strong. On the other hand, discretionary items, big ticket discretionary items such as grills and patios, not really great. Now, relative to the outlook, that's also a big piece of it, maybe the bigger piece of it, that they have brought down the full year outlook. Sales comps were expected to be flat for the year. The CFO talking about after 43% growth over the last couple of years, of course it would be slowing, but now they're looking at sales comps for the year of down 2 to 5%. So again, worse than feared. This stock, John, down more than 10% on the year, down 24% last year. That equates a decline of 30% from the top. The question is, when will they see some sort of bottom? I think that folks might have wanted to see that out of the quarter. We simply did not get that.
The stock is trying to recover. It's down about 2.7%. Abby, thank you. Let's turn to financials. Capital One moving higher after 13 F filings revealed that Warren Buffett's Berkshire Hathaway added the stock to its portfolio in the first quarter. This coming ahead of the Senate hearing on the collapse of SVB and Signature Bank at 10 a.m. Eastern Time. Shanali Basak has more. Hey, Shanali.
Hey, John, if you take a look at it, it is a really remarkable tale of two cities. When you look at the financial system, you have Capital One just soaring pre-market, now down over 1 year, over 17% on the year. If you look at it, it's only really down 4% on the year. Why is that so remarkable? You have Capital One in the first quarter of this year and Berkshire buying it anyways, by the way, John, in the first quarter of the year, saying loan loss provisions have quadrupled. And with that said, the CEO has previously said they expect labor markets to significantly worsen over the course of the year. With that said, maybe Buffett is saying the worst is over and the market following them in. Remember, this is a management story as well. You have Richard Fairbank over at Capital One, really running the company since the 90s here. And if you look over at the likes of Silicon Valley Bank, we are talking about management once again and in a different way. We already have prepared remarks to kind of tease ahead to what we're going to see later today over at SVB and Signature as they testify in front of lawmakers in the Senate. And by the way, tomorrow gets even more interesting when you see First Republic's former executives testifying in front of the House as well. But interestingly, you have an SVB executive currently blaming the Fed, saying that for so long they said inflation is transitory and then hiking interest rates as fast as they had done. Remember, we know the Fed has blamed management of both Signature and Silicon Valley Bank as well. Let's see how much lawmakers do the same. And one thing we expect to see them do is address executive pay and stock sales of these firms as we look to how we turn the page from some significant bank failures in the United States and how banks should maybe be managed differently in the future.
With great difficulty. Shanali, thank you. The blame game down on Capitol Hill. What's new? That stock is up by more than 5%. I want to turn to tech, to Tesla, gearing up for its annual shareholder meeting later this afternoon after George Soros cut his holdings in EV makers, including Musk's company. Joining us now is Ed Ludlow. Morning, Ed.
Yeah, good morning, Jonathan. We got that from the 13F on May 12th as it relates to George Soros, a $16 million stake that he'd come into in the second quarter of 2022. But remember, at that time, Soros was looking quite broadly at tech. That stake now gone. I would also note on the Bloomberg this morning that JP Morgan, John Hancock, other names have cut their exposure to Tesla in the most recent quarter. There's actually a lot going on ahead of the AGM. I think we're up by about 0.2% or so, treading water. Bloomberg reporting overnight, according to sources, that in Shanghai, Tesla is getting near to trial production of an updated and revamped version of the Model 3, slightly longer wheelbase, sleeker interior design. But that process of developing that product moving forward in Shanghai, according to sources. And then we had the AGM. We will get votes on board composition. Most interestingly, whether J.B. Strawball, a co-founder of Tesla, and of course the CEO of Redwood Materials, should be added to the board. Most investors looking at a shareholder proposal for Tesla to issue a key person risk report, a report which basically looks at individuals with the company and their core importance to Tesla, of course, with Elon Musk recently announcing that Linda Yaccarino will become the new Twitter CEO. There's been some thinking that Elon may now be more focused on Tesla, having been spending a lot of time at Twitter since April of last year.
Ed, thank you, mate. Appreciate it. That stock is positive by 0.1%. Mohammed, I wanted to come to you. Just looking at the equity market about 5 or 6 minutes into the session, we are negative by 0.2% on the S&P and the Nasdaq by 0.1. Can we go back to 2011? You're at PIMCO. You're going through this debt ceiling drama. What were the lessons from that for this right now? Lots of similarities for you?
Yes, except that this time around, the front end of the Treasury curve is behaving differently from back then. But I think the view then is the market view now for most market segments, not all, most, which is you should look through this, is going to be resolved because ultimately the consequences of a debt default are that both parties get blamed. So at the end of the day, you will get a solution. The question is, what are the compromises that need to be made? It's interesting that the principals are meeting today. Normally, you don't put the principals in the room unless the staff got to some sort of agreement.
And yet we're told that the staff haven't got to an agreement and have barely made progress, depending on who you listen to in Washington.
Yeah, depending on who you listen to in Washington. That's the issue, right?
Going forward from here, Mohammed, is it the European-type playbook that you need to get close to crisis before you provide a solution? Is it that down in Washington?
It is that for the debt ceiling, yes.
Do you see it spilling out from the at-risk maturities at the moment to somewhere else in the market, or does it remain contained there? Is there broader market risk here for you?
So I think the broader market risk is low, but that is what the market thinks as a whole. So if it turns out that we're wrong, there's going to be a lot of damage.
Plenty of reason right now, apparently, for some optimism and to be gloomy too. Bank of America's latest fund manager survey picking up on both the gloom and some of the optimism as well. Global growth expectations coming in at the worst levels of the year, pushing investors out of commodities and into tech stocks, reflecting the pessimism. The most crowded trade right now, long big tech, short banks. But the majority of investors still hoping for a soft landing rather than a hard one. The vast majority expecting a debt ceiling resolution before the ex-date. And survey participants, wait for this, forecasting just a 1% drop in global EPS in the next 12 months. I'm pleased to say that joining Mohammed and I to discuss this is Tony Dwyer of Canaccord Genuity. Tony, wonderful to catch up with you, sir. I picked out a quote from your note this morning. Everything is fine. You can tell us what fine actually stands for in just a moment. You caught up with clients recently, and just based on those conversations, this is what you concluded. They are hesitant to get optimistic given the macro backdrop an increasing likelihood of recession, yet nervous to become overly negative given the damage that has already been done underneath the surface of the S&P 500. Tony, where on earth does that leave us?
Fine is where it leaves us, which is frustrated, insecure, neurotic, and emotional. And I don't see any reason that that's going to change. And going back to the whole debt ceiling debate, let's say it gets resolved in the next 15 minutes. The market's going to bounce. Right now, there's probably some investors that are not going into money market funds because the only thing they own is really short-term government paper. So there may be, if you do have more money flood into money market funds because of the debt ceiling debate resolution, you're going to have it come out of the deposit base, which is all in. It's going to increase the lack of availability of money and tighten lending standards.
What are you advocating for at the moment then, Tony?
John, I am annoyingly boring and consistent, which means we're light and tight. We're holding a bit more cash than would normally be the case, and we're slightly defensive. Again, with the Russell 2000 back to literally the pandemic low relative to the S&P 500, now's not the time to say, okay, things are really at risk. That said, you could get one more whoosh lower because there's 3 stages of a decline that's economic based. You get the good news is bad news, means Fed's going to tighten. We got that last year. You get the bad news is good news. Okay, they're going to take the foot off the throat of the market. That's been recent. And then you get bad news is bad news when you really actually have to price in a recession. And I think that's the final move when everybody's kind of panicking that I want to go on attack mode. So I don't want to get too negative, but I do want to own a little bit more cash and have a little bit more defensive posture.
Tony, a lot of people have picked up on valuation issues between the Russell and Apple. The fact that Apple is now worth more than all of the Russell. What would make you go long Russell, short Apple?
Well, Mohammed, I can't talk to Apple, but let's talk about the NASDAQ or the S&P 500 market cap indices. I don't think that's a bad, I've said it publicly, I don't think that's a bad idea right now. You're at a level that has already generated such a significant underperformance of the Russell 2000. And earlier, John, you talked about the Bank of America survey, right? And it said the biggest long is big cap tech, the biggest short is banks. That's the same trade. right? You're long, if you're long the S&P because it's index based, and you're short the banks, you're probably short the Russell. So that's really the derivative of that. And I'd like to point out, going into yesterday's close, guys, 99.47% of the market gain for the year-to-date gain in the S&P 500 was the top 8 stocks. It's a market cap index. Typically, the biggest stocks do have the biggest impact, but that's outside.
Well, Tony, just to clear something up, when you say you stand ready to buy into weakness, what does weakness actually look like there? Where are you looking for that weakness to buy into?
And there's the rub. So this is going to come across as, you know, really bearish, but it's below the October low. So here, let me throw some where it would be unique to have October be the low. When you look at it, we wrote a note that everything is fine. In that note, it has the New York Stock Exchange advanced decline volume line has made a new low. That's not happened before. Typically, that's surges. So if October was the low, this one's going to be historically unique on that. The S&P 500 has never made the low prior to a peak in the 2-year. So if October is the low, it would be historically unique because we made a peak in the 2-year on March 8th of 2023. And in addition, you've never made the low before you've had a recession, and you've never not had a recession with all the macro indicators that we talk about all the time.
It makes a lot of sense. Tony, thank you, sir. Tony Dwyer, great note this morning. Enjoyed the read. Simultaneously anchoring Bloomberg Surveillance and reading that note at the same time. Mohammed, how perfect is this? You go through the Bank of America Fund Manager Survey, and I think it sums things up pretty well. Global growth expectations, worst levels of the year, reflected in some of the pessimism out there that you hear. Investors going into tech stocks, out of the commodity story, the pessimism, the crowded trades right now, short banks, long tech, all of that. And then you get this idea of a soft landing, rate cuts from the Federal Reserve, get a resolution to the debt ceiling, survey participants only forecasting a 1% drop in global EPS. Does that all sound a little bit too perfect for you?
The hopeful part of it sounds a little bit too optimistic for me, but that is completely consistent with the behavioral side of investing. It's completely consistent.
What's going to change that? Data and time?
I think data, time, or an accident. And I hope it's not the accident part, but I hope it is data and time.
I think we all hope it's not the latter. About 13 minutes into the session on the S&P 500, we're just about negative by 0.1%. Coming up on the latest data, China data, disappointing.
Momentum for the growth is still not broad-based. It's still not solid yet. So the question is here, which policy stimulus is most important?
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Richmond Fed President Thomas Barkin. That conversation happening at 10 a.m. Eastern, 3 p.m. in London. This is Bloomberg.
Momentum for the growth is still not broad-based. It's still not solid yet. So the question is here, which policy stimulus is most important? I think that industry policy probably will play a more important role than fiscal stimulus, particularly on the consumption stimulus. Much policy can play a supplementary role, but I think that the rate cut is not the most urgent policy response at this moment.
Whatever happened to the boom in China? Signs emerging already that the recovery is losing momentum. Official data showing industrial output and retail sales growing at a much slower pace than expected in April. The calls for stimulus already picking up. Michelle Lam of SocGen saying this. Today's data opens the door for further cuts in the reserve requirement rate and interest rates possibly in June. Damien Sassad joins us now for more. Morning, Damien. Your thoughts on that data overnight?
Yeah, no, I mean, the recovery is, it's lacking some substance here, Jonathan. I mean, for me, it's really about, retail sales, obviously. The decline there month over month sequentially is pretty significant, and what we're seeing here is sort of a transition. It's going to be services led, at least whatever recovery we do see in China. You're seeing demand for durables go down, and you're seeing youth unemployment rise to a record high. So that can't be good on a sort of structural medium to long-term basis.
Are we really at that point, Damien, where we're talking about stimulus, rate cuts, fiscal easing?
I mean, when are we not talking about stimulus in China, Jonathan? Of course we are. I think now we're looking for something on the order of a 10 bip cut in the 1-year MLF. I think May 21st next week is going to be the next meeting there. We could see it then, certainly. But I think, look, investment in China is lackluster, has to do with the housing market. There's no signs of a recovery on that front. So, look, the verdict is still out, but definitely the recovery in China is lacking in substance.
Damien, some people might be saying what happened to the boom, the big reopening trade that we're all talking about at the end of the year coming into 2023. Is there a sign of a boom somewhere in the services sector reflecting that reopening enthusiasm?
Yes, jet fuel demand, airlines. So you are seeing international flights come back online. You are seeing that kind of pick up. I think JP Morgan projects that jet fuel demand out of China is going to be responsible for 25% of all growth this year in energy demand. So, you know, we're seeing a little bit of that now. Domestic flights have certainly recovered. But yeah, I know we need to see international flights pick up, and there's been a lot of cancellations from the big carriers in China, Jonathan. So I'm watching that pretty closely.
Interesting. Damien, thank you, mate, for the update. Damien Sassa there. Mohammed, back with us. Mohammed, I wanted to share this quote with you from Mislav Matejka at JP Morgan. Sums it up quite nicely to start the week. Just this consensus is starting to break just a little bit around China, around Europe. Mislav Matejka said the following: the activity upswing seen around the turn of the year, helped by the falling gas prices in Europe and by China reopening, unlikely to transition into an acceleration in the second half. Where are you now, Mohammed, on both China and Europe?
So I would agree with that. And I would agree with that because I listened to one person on growth issues, and that's the Nobel Prize winner, Michael Spence. And he's made the point over and over again that neither China nor Europe have potent growth models anymore. That the growth models that they had are no longer able to leverage the global economy like they used to. And therefore, they have to accelerate their structural reforms at home. So once you get the bounce out of the way, the bounce in Europe from the energy shock, the bounce in China from the zero COVID policy, sustaining high growth is going to be much more difficult than what most people expect. And that's what we're seeing starting to happen.
So what does that mean for monetary policy at the ECB, given they've taken rates towards 4% and through 3%?
They only have one objective: inflation.
So lower growth and ultimately, hopefully, lower inflation. Is that the future of Europe?
That is the way Europe is heading.
Or do you end up in the worst case situation where you get the lower growth and the sticky inflation?
Inflation in Europe is not as sticky as inflation in the US.
Why not?
Because the underlying economy wasn't as strong to begin with. So you didn't get the massive acceleration of inflationary pressures and the move-in survey. You know, we haven't talked today, but the 5 to 10 year inflation expectation in the US have moved up substantially.
You mentioned on Friday. What do you think that tells us?
That tells us that inflation is not proving to be sticky, yes, but in addition, inflation expectations are starting to react. Remember, inflation expectation, they move very slowly up and they take a long time to come down. So we have to pay attention to that.
So this goes back to how we started the conversation this morning. Is the effort to get inflation back towards 2 time sensitive? Is there a window here that if you don't achieve ultimately your goal, you end up with something nastier further down the road and something you've got to live with?
That window was in 2021.
You think it's closed?
I think it is very narrow right now. Very narrow right now. That window was wide open in 2021. Unfortunately, we got stuck with the transitory mischaracterization, and even when that was amended, the Fed didn't move quickly enough. But that window was wide open in 2021 and in the beginning of 2022. Now it has closed to a very large extent. Now we need some good luck to open it again, but I don't like relying on good luck, honestly, when it comes to such an important policy.
Are we going to be talking about the S word at the end of this year?
We're already talking about the S word.
Is that your base case now?
It's not my base case. I think this economy is more resilient than everybody that has called for a recession. You've heard me say that over and over again. When even Bloomberg Economics came up with this 100% probability of a recession in the first half of this year, I said, no, there isn't. Absolutely not. This economy is more resilient than most people realize. However, it is not resilient to lots and lots of mistakes, nor is it resilient to financial accidents.
Let's talk about this market right now. 22 minutes into the session, we are down by 0.3%. Let's get you some sector price action. Here's Abby.
We are looking at a small decline for the S&P 500, John. Not a lot of drama beneath the lid, though. If we lift the lid, energy down 1.2%, materials down about 1%, staples down 0.7%. Interestingly, consumer discretionary outperforming, even though it's down, being weighed on by Home Depot. On the year, or over the last year, it's interesting to see the outperformance for consumer discretionary and against consumer staples. On the year, it's even more pronounced on discretionary, up about 14%, staples up just slightly. Interestingly, Home Depot is consumer discretionary, but it has to do with Tesla and Amazon, Booking, McDonald's, Starbucks, a lot of strength there.
Coming up, the market moving events you need to be watching. That's next in our trading diary.
That was beautiful. You've got to thank the reporter, though, Mohammed. You've got to say thank you to Abby.
Oh, thank you, Abby.
And then do the tease. Your trading diary up next. equities just a little bit softer here this Tuesday morning. Good morning to you. Here's the trading tower at the top of the hour. The Senate Banking Committee holding its hearing on SVB. Fed speak continues with Richmond Fed President Tom Barkin catching up with Mike McKee at 10:30 Eastern Time, followed by an interview with Chicago Fed President Austin Goolsbee at 2:30. Debt ceiling negotiations resume at 3 p.m. Look out for that this afternoon. We round out the week with another round of jobless claims on Thursday morning, and President Biden attended the G7 Leaders Summit in Japan, and Chairman Powell speaking on Friday. From New York, that does it for me. Thank you very much for choosing Bloomberg TV, and thank you to you, Mohammed. Great to catch up with you. Thank you, sir. Just about holding on to this job here in New York City. This is Bloomberg.